The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk about taxes because we're in the middle of tax season, and we will talk about the 17 tax laws, which are in effect when you file your return this year, and 18 that's phasing in. We want to talk about taxes. We want to help you, and I'm joined in studio with Tiffany Fabian.
Hey,
Tiff.
Hello.
And we left Chris
Saturday.
every other week. So Tiff will come one week, Chris will come the other week.
Yep.
Because somebody's got to be there minding the fort, right?
It works like a well-oiled machine.
So we got 33
crazy.
offices open, 9 to 9, Monday through Friday, 9 to 5 on Saturday. We will help you. We're offering the
Easy Advance.
Easy Advance loan up to $2,500 with no APR and no fees for the money, because unfortunately with all of the fraud that is associated with earned income credits and child tax credits, the IRS is not going to be sending out refunds for the earned income credit and child tax credit till the middle to end of February. So if you're somebody that's going to not get a refund till then, you might want to apply for the Easy Advance up to $2,500, and at least you get something, then you get the rest of the money later.
Yeah, one of my clients called me this morning and she goes, Tiffany, I got a text and I was approved and it told me the money's going to be in my account, which is pretty cool. I was very happy for her.
Oh, I know, it's wonderful. So all of our offices are open. If you have questions and the IRS is not answering them, we will answer your tax questions. You can call any of our branch offices. You can call for that information by calling our corporate office at 632-7886. And for those of you that haven't gotten your W-2s yet, they will be rolling out. Your statements from your brokers probably won't come till mid-February, end of February, maybe March. So the important thing to do is to make sure you got all those forms lined up. Don't rush in to file your return. All you'll do is cause yourself a problem if you don't have all your income on your tax return.
That's right. Yesterday, I got a person, I'm doing their return, and he forgot that he sold some land. So we got a 1099 for the sale of land. And so now
then you got to amend the return.
Right.
Right?
Correct.
Right. I'm Esther Gulius, the Tax Lady, 803-0930, 803-0930, star 930 on a cell phone. And I will tell you, I was so blessed yesterday. Last night I had a new client that came in, and she's always done her own return. And what she didn't know, the sad part is, she didn't know that even though that she's the custodial parent, that means the child lives in her home, but she gives the daddy the right to claim the child. So daddy claims the child, gets a child tax credit, but she didn't know she qualified for the earned income credit.
Right.
So she's pretty much left $1,500 on the table for the last 7 years.
Yikes.
So it was great. I can amend the last 3 years' return and get her the money back. But that's the sad thing when you don't, your return is mathematically correct, but if you don't know what you're looking for, you don't know what to look for.
And the IRS never sends her a letter or drops her a note and says
because the IRS doesn't know that she's
true.
got a kid living
Yep,
at her house,
that's
right?
Yep. It's really sad. I had a similar situation. I do the boyfriend's tax return, and he said to have the girlfriend come, his fiance, and she's like, no. I always use a software package, and so same thing. She's the custodial parent for 2 kids, and the ex is the non-custodial. He gets to claim one, so she wasn't getting earned income credit for the other one.
Children.
And she's been doing it since 2006. So I amended the last 3, but there was a lot of money that is beyond the statute.
Because after the statute closes, you can't get that money back. So I was talking to somebody yesterday. The important thing is if you're doing your own return, have somebody double check it. Yep. Because those kind of things, when you miss a credit, you say, even I had a guy that called the other day and he said, I only made $5,000 last year because I'm disabled. Okay. And I'm applying for Social Security. We're getting social services while we're waiting. He said, and I got 2 kids at home. We shouldn't file because I don't have to owe any taxes. I said, you don't owe any taxes. They owe you.
Right. but that's hard to wrap your mind around.
Right.
Even though you didn't pay in, you still have some refundable credits coming your way.
So, last week, and I'm Esther Gilius, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. We had somebody that called and said, what is the itemized deductions and how are they changing? So we're going to talk about itemized deductions today. So there are like 6 categories of itemized deductions. There's medical, taxes, interest that you paid on mortgage and some investments, charity, casualty and theft losses, miscellaneous deductions subject to 2%, and regular miscellaneous deductions. So that's what makes up itemized deductions. If you have more of these than standard deduction, then you want to use these because they reduce your tax liability.
Correct.
Right?
Yep.
So under medical, these are some of the things that would go under medical. Acupuncture, air conditioning, removable air conditioning to relieve like asthma for allergies. Ambulances, artificial limbs, birth control pills, braille books if you're legally blind, breast pumps, breast reconstruction due to cancer, and any kind of cosmetic surgery due to a physical
ailment.
Yeah. Disability camps. If you're disabled and you send your kid to camp to help them. Capital expenditures to make your home more user friendly for a disabled person. Grip rails. You have to take the bathtub out and put the low thing in. That's deductible as long as it doesn't increase the value of the home. Mm-hmm. Hand controls for your car. If you are somebody that's unable to drive without them. Chiropractors, contact lenses, cosmetic surgery to correct a deformity, dental treatments, diagnostic services, doctors' drug addiction treatment, glasses, fertility enhancement, like if you want a baby and you do in vitro fertilization, that's like $10,000 a pop, by the way. Mm-hmm. That's deductible. Guide dogs, the food for a guide dog. Taking vet for the guide dog, hearing aids, batteries, hospitals, nursing care, insurance premiums for medical, lab fees, lead paint removal. If you have lead paint in your house and you have it removed, that's a medical expense. Lodging when away from home when seeking medical attention, medicine, orthopedic shoes, oxygen if you can't breathe on your own, smoking cessation programs, therapy, travel at 19 cents a mile, wheelchairs, and basically anything to alleviate a specific medical problem.
And then don't forget that medical has to super exceed 7.5 of your adjusted gross income. Last year it was 10%.
Well, it's actually 10% this year, 7.5% next year.
Yep.
And medical is still deductible with the change in 18. Okay? I'm Esther Goliath, the tax lady, 8030930, 8030930, star 930 on your cell phone. We're going to take a short break, and we'll be back with your questions on the other side. Hey, I'm Esther Goliath, the tax lady, 8030930, 8030930, star 930 on your cell phone. We have 33 area offices open 9 to 9 on weekdays, 9 to 5 on Saturday. We can do it all for you, whatever type of return. We would love to help. And we're talking about itemized deductions. We had a caller last week that says, talk about itemized deductions. So we're talking about itemized deductions. What's deductible now? What's going to be deductible next year? Because this year, when we're doing tax returns, nothing is being phased out. It's the 2018 returns that are affected by the itemized deductions.
That's right. Yep. A lot of people will sit there and like, okay, so we're going to brace myself for the changes right now. And it's like, no, when you sit here next year is when we're going to. And
every time we do a tax return, we let everybody know what the changes are. I had a client the other day who's got 3 children, husband and wife. He had an office and home. He travels for his company. And he has a lot of property taxes for New York State, and other property and other taxes, and we're going to talk about that in a minute. So they're being capped at $10,000. He ends up, because he loses his personal exemptions and these deductions, with an extra $26,000 in taxable income, which moved him into a higher tax bracket. And so when I told him next year he's going to lose $4,000 in refunds, I thought he would have a heart attack.
Yeah, well, and actually, I just did my cousin's tax return, and she works from home, and so there's the office and home. There's a portion of all her expenses, and so it's really
over-the-road truckers. I had an over-the-road trucker the other day who used to get 80% of his over-the-road meals and his meals and things overnight. He's losing that, and so he's going to end up owing $2,000 more next year.
And
those are things you want to know. Right?
Very important.
So, itemized deductions. Sales taxes are deductible. If you're somebody that pays large sales taxes, maybe you bought a car, a boat, and your sales taxes are larger than your state withholding, then you're not only could get your state withholding or your sales taxes, whichever is larger this year. Property taxes are not capped. So you could have a primary home, second home, a vacation home. This year, they're still deductible. And personal property taxes and foreign taxes. Right?
Yep.
Next year, that total is going to be limited to $10,000.
That's right. That's the SALT that they talk about, the state and local tax,
right,
with the cap of $10,000.
Okay, why don't we go to the phones and we're going to talk to Bob. Hey, Bob, how can we help you? Hello? Hello, Bob? No, Bob.
Oh, wait, here comes Jay.
Yeah, Jay. What happened, Jay? Hello, Bob?
Hi.
Can we help you, Bob?
I have a partnership, and with the new tax code, I was just wondering what the new pass-through rate would be.
It's going to be 20%. As long as it's a qualifying partnership. Now, is it personal service? What type of business do you guys have?
It's professional services.
Like what? Give me the type of business.
Engineering and surveying.
All right. Engineering actually is exempt from the cap that other businesses have. If it were a personal service business, except for engineering and architecture, which got a pass at the end, you would be limited if the net profit, your adjusted gross income, were over $350,000 because you wouldn't, and there's a phase out to $450 if you're filing a joint return. In your situation, it's going to be 20%.
Awesome.
Okay.
All right. Thank you very much.
All right. Thank you, Bob. I'm Esther Gullius, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. So next year, property taxes itemized are going to be capped at $10,000.
Right.
But this year, it's A-OK.
That's right.
And one of the things we suggest is if you have a vacation property outside the area and you have never thought of renting it because you're going to lose all this deductibility, think about turning it into rental property.
That's right. I was with a couple today, and they have a house here and they have a house in Florida. And so I was telling them, their house here or their house in Florida, you can only take one next year, and so you might want to turn it into a rental. And they said, no. What we want to do is eventually sell the house here in Buffalo and move to Florida and make that.
But in the meantime, they end up paying all those extra taxes,
that's
right? All right. The other thing that's deductible is an itemized deduction, and again, all these things add up. Would be investment interest. Like let's say you have a margin account and you borrowed money at your brokerage. That's an itemized deduction. The personal interest on your car and things are not deductible. Mortgage interest on your residence and your home equity is deductible as interest. And that's going to be capped next year on a new mortgage up to $750,000. Now it's a mortgage up to $1 million. Okay.
Right.
But that's deductible. And next year, home equity interest will not be deductible. So if you're somebody that's sitting on a home equity credit line and you don't have a primary mortgage, think about refinancing so that would be deductible if you're going to be able to itemize it all next year.
That's right. Yeah, a lot of people have to make sure that they wrap it in and get a primary so they can get rid of that equity interest.
And, of course, without itemizing, your student loan interest is still going to be deductible up to $2,500. Right?
Thank God.
Okay, I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. And we're going to go back to the phones and we're going to talk to Joe. Hey, Joe, how can we help you, sir?
Yeah, I was wondering, I'm on disability. I own a home. Can I file a tax return?
All right, Joe, how old are you?
I'm 62 now.
All right, and are you receiving a disability pension?
No.
Just strictly Social Security?
Yeah.
Okay. Had you been on a disability pension, there would be a different answer. But on Social Security, there's no credits available to you because it's not going to be taxable to you. And so, no, you're not going to get any benefit for your home.
Oh, okay. So basically, there's nothing to file.
That's exactly right.
Okay, thank you.
All right. Thank you, Joe. Now, the reason I was lingering over that is because if Joe were on a disability under normal retirement age, then that disability would be considered wages.
Right.
And he would be able to be qualified possibly for an earned income credit, is whether he's single or if he had children. So that's really important that if you're out there listening and you're on a disability and you're under normal retirement age, your disability pension is actually considered wages and you might qualify for the earned income credit.
Yeah, a lot of people get confused because he said he owns a house, and so he was wondering why he can't take advantage of writing that off. But
he doesn't owe any taxes.
That's right.
And the thing is with income taxes, it's not if you have to file because you have a tax liability. With all the refundable credits, you want to file because they might owe you money.
Yeah. I was thinking
even if you paid nothing in.
I was thinking about the property credit. If his house is worth less than $85,000 and his Social Security is less than $18,000 a year,
he might get a refundable
property credit.
Right, property. I think it's called circuit breaker credit.
Right.
Okay, going back to deductible interest, points are deductible when you acquire a mortgage. Again, and you can also. It's an interesting thing. There is an election to capitalize taxes and interest. It's regulation ruling 1.266-1B1. So you can make an election to capitalize your property taxes and mortgage interest that you aren't claiming, and that would increase the basis. So if you're not allowed to take it, you might make that election to increase the basis on your home, like a vacation home.
That's cool.
Right?
That's pretty nifty.
That's a nifty key thing.
Sometimes I'm thinking, can I use that tool too? That's
right.
Very good.
And so those are things that are important for you to think about, that you want to plan with your financial plan, your tax advisor, because as these things are rolling out, the whole tax code is changing.
Yeah,
right?
It really is.
Well, actually, not the whole tax code, but the itemized deductions. I'm Esther Golias, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone. And how about MIP, Tiff?
That's gone right now this year. No longer can you deduct MPI, mortgage premium insurance, unfortunately. So that's something that's not available this year, and it's gone. And so that's a sad thing for all those people who have to have mortgage insurance, myself included. That's something I can no longer deduct.
Right.
Yeah.
All right. And then moving on, we're going to go from interest to charity. Now, any money that you give to a qualified 501c3 charity is going to be deductible as a charitable deduction, right?
Correct.
Plus, if you use your car to do charitable work, you can take 14 cents a mile for all the charity work you do, like if you're a docent downtown at Shays or something.
Or if you're a coach, a soccer coach,
and
or
you
if
travel
you're a
all around.
baseball coach,
Right.
and you travel all around, you can take those miles.
Right. And you do need substantiation for any contributions that are at a one time over $250 or more. And
right.
This is still deductible even on next year's return. So it's deductible now and it's deductible next year.
Right.
Okay. And another thing that people might be want to be aware of, if you're somebody that does large contributions and you have a required minimum distribution from your RMD and you're not able to itemize, what you might want to do is do the direct rollover from your IRA to the charity, and then it won't be taxable on your return, and it won't make your Social Security more taxable.
That's right.
Right?
And that's part of the planning.
Part of the planning.
Yeah.
I'm Esther Golias, the tax lady, 8030930, 8030930, star 930 on a cell phone. And let's go to Dave. Hey, Dave, how can we help you, sir?
Hello. I called last week and asked you to go through the schedule.
Well, see, am I obedient?
And you told me to listen. I thought you'd forget.
No, I do what people say.
Hey, I had two clarification or two quick questions on.
Yeah.
The first one, as single, is the standard going to be 12K even, or is it 12.6?
12.
It's 12?
Okay.
12 single, 24 married joint. But they may adjust it for cost of living. I don't know what's going to come down the pike later. But right now it's 12 and 24.
Okay. And I thought I heard you say that line 3 was 10% this year and 7.5% next?
That's right.
For tax year 2017, I'm looking at the form.
I heard it was
Oh,
7.5.
no, it's 7.5. It's 7.5.
Yeah, she
Yeah,
corrected
7.5,
me,
yeah.
and I thought it was 7.5.
Yeah,
but
7.5.
Okay.
It was 10 for 2016.
That's right. That's right. And 7.5 and next year as well.
No, okay, so next year it is 7.5.
Right.
Okay, that's what I wanted to clear up.
All right. Now, I'm not done with the itemized deductions, so I'm being obedient.
Oh,
All right?
it's a
Thank-
girl.
Thank you. I'm Esther Gullius, the tax lady from EG Tax. We're going to move on here, and then on the other side, I'll take all of your questions. I know we got a bunch of them. Miscellaneous itemized deductions, estate taxes, repayment of income more than $3,000, gambling losses, handicapped expenses are allowable next year, not subject to 2%. And 2% employee business expenses, over-the-road truckers, hobby expenses up to income, investment expenses, job hunting, job-related education, loss on an IRA investment, union dues, repayment of income under $3,000, safe deposit boxes, uniforms, subject to 2%. That's all going away next year.
Wow.
So over-the-road
That's a lot.
truckers, I don't know what happened to the Teamsters. They let
Their
this
voice.
happen, right?
We're
going to take a short break for the news. I'll be back on the other side with your calls. Gary, Larry, and Betty. We'll see you on the other side.
It's been 1 week since you looked at me. Got your head to the sides and I'm angry. 5 days since you laughed at me.
Hey, I'm Esther Gullius, the tax lady from EG Tax, and we're going to go to the phones now and answer a bunch of questions. Hey, Gary, how can we help you, sir?
Yes, I have 2 questions for you. One for 2017 tax year.
Yeah.
If we paid our 2018 town property tax, are we going to be able to write that off in the 2017?
All right. In order for you to have them be deductible, now the governor did an emergency executive order that said that the cities were able to issue warrants, and as long as they were paid before December 31st, and the warrant was issued by the town, then you can take it off on your 2017 return.
Okay. The other question I had is for the 2018 year. If we contribute to a 401 plan, is that still going to be taxed?
Yes. Really, I have to tell you, the major change was the fact that there's a pass-through on businesses, and the corporate rate was reduced. They eliminated the dependent and personal exemptions. They eliminated miscellaneous itemized deduction and put a cap on taxes. And that's kind of it in a nutshell.
So the
rest,
pension,
everything else stayed the same.
the pension, you're okay.
Yep.
Yeah, originally they were going to eliminate that, I believe. So, but they
Right, but they didn't. That would have been
They would
horrible.
have they were going to make it like a Roth IRA after
Right,
tax.
right.
Yeah, which would have been really bad. Gary.
Okay, Gare?
Okay, thank you very
Thank you, sir. I'm Esther Gullius, the tax lady, 8030930, 8030930, star 930 on a cell phone. And we got Larry in Georgia. Hey, Lair.
Hey, Esther, darling, how are you?
How you feeling?
Well, darling, every day's a blessing. Every day is a blessing.
Oh, that's great. How can we help you, sir?
Thanks for a couple of things. One on the R&D charity. So I understand that would have to go directly from the R&D to the charity.
That's right.
Okay. 2, I understand that once we set it at 70.5, you can donate up to $100,000.
That's right.
Okay. 3, I read that there's nothing called I think it's called a charity durability, something like that, trust.
You can do a charitable remainder trust. Yep.
Okay, you like set that up with Vanguard. Is that a cost-effective way of giving to charity and also getting a deduction? And how is it different from donating the RMD directly to the charity?
Okay, so in an RMD, you're actually eliminating the money. It's going from here to here, and it's fulfilling your required minimum distribution. Okay, on a charitable trust, it means that you're taking liquid assets, forming a trust, marking out who the owner of who the beneficiary of the charity is going to be, and it ends up being an itemized deduction.
Okay. So you could take both as an itemized deduction, as well as the standard deduction, correct?
No. You can take either the standard deduction or the itemized deduction, but charity, they allow you to take up to 60% now within 18 of your adjusted gross income as an itemized deduction. The rest of it carries forward up to 5 years.
Esther Duggan, thank you so much.
All right, Larry. God bless you.
You too, sir.
Bye-bye. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Now we got a different Larry from Buffalo. I bet you don't have an accent, Larry.
I was confused.
How can we help you, sir?
Two things. One is I pay about $4,000 in taxes and $3,500 in interest. Would it be? Should I take that or should I take the $12,000 deduction?
Okay, the $12,000 deduction is next year. Are you single?
Yes.
Okay, so that's next year.
Okay.
All right, so this year you're going to go by the regular standard deduction, which is $63.50. Okay, so you would itemize if your itemized deductions come over $63.50.
And so you said $4,000 in taxes. Do you have a mortgage on your house too, Larry?
Yes.
And so you have
and
mortgage
you have
interest?
mortgage interest, right? And did you buy a car last year?
No.
All right, so you have. Did you pay New York State withholding?
I did. I retired in August, so 4 months I don't because I was a New York State employee.
All right, so you would have your $4,000 in property taxes, right? You would have your New York State withholding or your New York State sales tax and your mortgage interest, and you said you're single, correct?
Yep.
And did you give anything to charity that you'd have receipts for?
Well, just like church and dinners.
Right. So you would. It sounds like let's say you had $2,000 in New York State withholding and $2,000 in mortgage interest, you would be over. So it all depends on how much your mortgage interest is and how much your state withholding was and how much you gave to charity. But if it comes over $63.50, which it sounds like it does, you want to itemize.
And then how about for 18? What does it sound like for him?
Now for 18, it's just going to be the $12,000 probably.
Think that it depends on how much his state
Right.
taxes are and
Right.
your income tax.
But next year, if he's retired, how old are you, Larry?
53.
53?
Yep, 5.3.
Yeah, so your pension on New York State's still going to be taxable.
Right. Perfect.
So now, are you going to go back to work or are you just going to stay retired?
Hopefully stay retired.
Okay. So your pension is still going to be, unless you're a New York State retiree. Are you a New York State retiree?
Yes, I am.
Okay, so then your pension is going to be tax-free. So for those people listening, if you're a New York State retiree, city or municipal employee, all of your pension, regardless of your age, is tax-free on New York State. If you're not that, if you're just retired on a regular pension or IRA, you have to be 59.5, and the first $20,000 is tax-free. So it looks like you're going to itemize this year. Next year is a toss-up. What I'd suggest you do is give us a jingle, and we'll kind of plan for next year for you.
Okay, and then the other question I have, I'm going to become a Florida resident in the middle of the year. So then will I have to pay taxes for both states or just Florida?
No, Florida has no taxes. No,
And don't forget
income tax.
your pension is all tax-free on
And
the
New
state
York
of
State,
New
right.
York anyways.
So you can't be a resident in both places. So you're moving from Buffalo to Florida?
Correct.
All right. So next year, is it this year in 18, you're going to move to Florida as a resident, correct?
Yes.
So next year you're going to do a New York State part year resident, and then you won't do a Florida return because there is no Florida return.
Okay, thank you very much.
You're very welcome. Thanks for calling. Okay, and let's go to D. Nope, Betty, who's waited so long. Hi, Betty. How can we help you?
Yes, I have a question on minimum distribution.
Sure.
I take out of my IRA, and on the tax form, it was under 15B.
Mm-hmm.
I also have a TSP from the Postal Service, and I have to take the minimum distribution from that.
Okay.
That goes on 16.
Okay.
Now, as far as Enhanced Star, they only allow you to take 15B. Why can't I take both on my Enhanced Star? Maybe you don't know that.
I don't, because that would be a rule that the the city comes up with and the state of New York comes up with to see if you qualify for the special deduction on your property taxes. So what I'd suggest you do is talk to the municipality.
Okay.
All right.
And then don't forget, Betty, that if that money from the TSP is generated from the government entity, it's all tax free on the state when you do your return.
But she's talking about her star.
Yeah.
But that's the whole thing. Those are the laws from the municipality in the state of New York, so you have to check with them. We only know income tax, right?
Right.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 cell phone. Yes, ma'am.
I will say that we help people fill out their star applications all the time. So if she wanted to, she can come into the office and we'll call with her if she's struggling. Because we do help people fill it out.
Absolutely. All right, we'll go back to the phones. We'll talk to Dee. Hi, Dee.
Hi, Esther. Thank you so much for your information.
Oh, I'm glad I'm helping. Thank you.
Got girl power there today. I retired 10 years ago.
Okay.
One of the perks I got was they will pay my insurance premium.
Okay.
So because I'm
your health insurance, right?
My health insurance, yeah. Because I'm older, my Medicare comes out of my Social Security.
Okay.
And then my ex-employer pays my hospitalization business.
Mm-hmm.
So how do I prove that on my taxes? I understand there's some kind of a form or something you're supposed to get.
Well, actually, you on the form, you basically, it's going to ask you, do you have full health insurance? And you say yes. That's it. They are going to get the 1095, either B or C, sent to them, the federal government, and they'll know that you're covered. So you just, if they didn't get the 1095 form stating that you had health insurance, then you would have to prove it. But when you know you have health insurance, then you don't have to worry about it. You just mark the box that you have full health insurance for the year. Plus, you're over 65, are you not?
Yes.
So you also have your Medicare.
That's right, too.
And that's right on your Social Security.
Yeah, it's right on your Social Security. So not to worry, my dear.
All right. Thank you so much.
All right. Thanks.
Okay.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And which reminds me, there are many people that, well, I think there's many people. I know that in the state of New York, with all of the health benefits that New York offers, there's a lot of people that are getting free health benefits.
Yep.
But there's a lot of people that I've seen that just said, I can't afford health insurance. And the thing is, there's an exception to the penalty.
Yeah.
I just saw somebody the other day that there's many exceptions to penalty. If the lowest cost bronze plan is more than 8.13% of your modified adjusted gross income, then you get an exception to penalty code A, and you don't get penalized.
Not to mention, Esther, I was doing somebody's tax return yesterday. She's a married lady. They have 3 children, and they only make $22,000. And I said she's paying at work like $9,000 a year for health insurance. She might qualify for the essential plan. So you want to look at things on the marketplace instead of just going with what your employer says.
Yeah, just because your employer is paying your premium, part of your premium, and they're taking out a whole bunch of money out of your paycheck. Yep. If it's over, I'm going to use 10%, it's about 10%. If you're paying more than 10% of your wages to health insurance, you qualify to go to the marketplace for your insurance. You don't have to use the employer. So sometimes with some of these essential plans, it's $20 a month.
Right.
And it's like great insurance. So that's, again, something that EG Tax does, and we do not charge for helping you. So if you're listening or your kid doesn't have insurance, you would be surprised the rabbit you can pull out of the hat.
Yeah.
Right? I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. We're going to take a short break. We'll be back at the other side with Rich and Ricardo, who are holding on the other side. Thanks for waiting. Whoa! Hey, I'm Esther Golias, the tax lady from EG Tax. Look, we're here to help you. All of our offices are open 9 to 9 Monday through Friday, 9 to 5 on Saturday. We have real people in the office, not robots, and we will answer your tax questions. If you need help, you can call our corporate office at 632-7886. And we're here, and we're going to talk to Richard. Hey, Richard, how can we help you, sir?
Great program, Esther.
Thank you, sir.
Yes. Well, a few years ago, I received a love letter from the IRS, brought it into your office, and Christopher took great care of me. And it was for a 2014, year 2014.
Okay.
And it involved some 1099s that I had received from the county, which were actually rental income type income.
Sure.
And we explained that that income wasn't separate. It was included in the Schedule E.
Originally, yeah.
Yes, and they picked it up as extra income. So it was all clarified, and I got a letter back saying...
what a good boy you are.
Yeah.
Can you imagine if you didn't look into it and just paid it?
Right, well, a lot of people do.
Yeah.
Oh, absolutely. It would have been like an $800 charge.
Yeah.
For. Well, guess what I got yesterday?
A love letter.
Yeah, from the state now.
Oh, because of the first letter. Do you have the letter from the IRS that says there was no change?
Yes, I do.
So come on in. We'll write you a letter for New York State.
Oh, okay.
Yeah, there's freedom of information, so they
share information. Yeah, so we'll say, oh, see this letter from the federal. They assessed Richard, but he didn't owe it. See, here's the no change letter, and that'll get rid of your bill from New York State.
Well, I don't want to bother you. I could do that, but I'm happy to come in.
Well, I mean, we still have some slots. I think if you call the office, I think we still have some slots on Monday. But better Monday than I'll tell you towards the end of the week because we're going to get slammed.
Okay.
Okay?
Could I call there now? Or?
Yeah, call right now, 632-7886.
7886.
Thanks, Rich. Bye-bye. Okay, we're going to go to Ricardo. Ricardo, this is Esther. How can we help you, sir?
Hi, Esther. Thank you very much.
I love your name.
Oh, thank you.
How can we help you?
Esther, I have a IRA rollover.
Okay.
I'm 75 years old, and I've had a minimum requirement of about $5,000, but I need some money right now, and I wanted to ask you, if I take $20,000 instead of $5,000, I only have about $80 left in this rollover account. I know I'll have to pay tax on taking out this distribution, but will the 20 versus the 5, will that benefit me next year, or will I still have to take the minimum?
No, all right, so let's see if I can put this in. You are over the age of 70 and a half, so you have to do an RMD out of your IRA. The amount that you would normally take would be $5,000, but you want to take more out. And you want to know if you take more out, will that satisfy other years? Is that what you're saying?
Next year, like
no. It won't satisfy.
Good question.
But it is a good question. That's a deep thinking, Ricardo. But no, it's just going to be you're taking it out. Now, do you have any other source of income besides the IRA distribution?
No. Well, I have a small pension.
How much do you get in that?
About $12,000 a year.
All right. Are you married or single?
Single.
Okay. So what $20,000 is going to make your Social Security taxable. You know that.
Okay.
So let me ask you this. Is there any way that, this $20,000 is necessary that you take this money out right now?
Yeah, I want to buy a car.
And you want to pay cash?
Yeah.
The loans are so
all right,
cheap.
so the loans are really inexpensive, What you might want to do, just a thought, is take part of the money this year and then pay off the loan next year. Maybe take $10,000, borrow the money, make your little bit of a car payment, and then next January take out another $10 and pay it off.
Then none of your Social Security will be taxable.
Right.
Oh, that's helpful. Another question, though, is I have some health issues, and I plan on living a while.
Good. That's a great plan. I'm glad to hear that.
Yeah. But if I don't, is there a lot of peril if I die? My sister is going to inherit my paltry little estate, and if there's this paid off IRA of, say there's $45,000 left, will she have to pay tax on what she'll inherit?
Yeah, she will. She's going to pay income tax. The thing is, if you leave her as the beneficiary, she has three options. She can cash the whole thing in and pay the taxes when she cashes it in. She can annuitize it based upon her life expectancy, or she can take the payments out over a 5-year period. So she'd have those three things to make a decision. So she could say she wants $9,000, $9,000, $9,000, and $9,000, or whatever the figure comes out to be over a 5-year period. She could annuitize it and take a little bit, depending upon her life expectancy each year, or she could take the whole thing. But that would be, if you make her the beneficiary, you will give her those tools if you should pass prematurely.
And after somebody passes, you're supposed to satisfy all their debts and
Right.
things like that, car loans and things.
Right.
Oh, sure. Well, that's very helpful. She makes more money than I ever did. So I was wondering, I didn't ask you this question, would it ever be better for me to just take the whole enchilada out, pay tax on it?
Well, with $12,000 pension, and next year's standard deduction is going to be 12. That means that the first 12,000 is going to be completely tax free, and you're over the age of 65, so you're going to get a little standard deduction. So you're like at the first 14,500 is going to be tax free anyway. So if you take out the whole 45, you're going to end up paying like $3,000 in taxes on it. So, you know, if this thing is done right, you could hopefully you're living that if you keep taking out that money every year, you should be able to get away with paying very little taxes on it yourself.
I see that. Thank you very much, Esther.
All right, thanks, Ricardo.
But
Be well.
That's good planning, good thoughts.
I mean, it's a plan. It's coming up with a plan. With the standard deduction, though, he'd only be able to take out an extra $2,000 a year. Of course, because his Social Security won't be taxable anyway.
Right.
So that's
with the change for 18.
Right. And then we're going to go to Niagara Falls with Mr. Jim. Hey, Jim, how can we help you, sir?
Good afternoon. One question on the 2017 taxes. My sister lost her husband halfway through 2017, and I know that the federal government allows her to file jointly at the end of the year. Does
Correct.
state do the same?
Yep, they follow suit.
They follow suit.
Does she have children?
Well, they were both retired for the last.
Oh, okay. So none of the kids are in the house.
No, and they've been on standard deduction for the last. But I couldn't find anything about New York State. I had.
Yeah, New York State really is in a conundrum right now because New York State follows federal law. So New York State right now is trying to figure out what to do with their own returns starting next year. And so you've heard, I don't know if you heard Governor Cuomo's engaging in a lawsuit because they don't like some of the changes in the federal tax law. But federal and state parallel one another. So you're going to see some major changes happen to the New York State return. But the filing status would be married filing
And then,
joint.
of course, 2018, she'll revert to single
Right.
unless she gets remarried. And so she's going to want to do some tax planning.
I didn't find anything on New York State, for 2017. I know that the federal government allows.
Right.
Okay, thank you very
You're welcome, Jim. Thanks for calling.
Okay.
Bye-bye. I'm Esther Golias, the tax lady from EG Tax. 8030930, 8030930, star 930 on a cell phone. I think we can squeeze in a couple more questions if you have them. Okay, Tiff, so what would you tell people to look out for? You're a big proponent on married filing a separate return because many times you do better filing separately.
For instance, a return I'm doing right now, they both make decent money. The husband makes more. When you put them together, they lose the child tax credit. However, next year, that threshold is much higher, and so it won't be an issue. I think that married filing separate won't be so much of a player
in 2018.
In 2018.
And another thing, on the way over, we were one of our offices called and said that a client wanted to file married separate because of an outstanding student loan.
Right.
And we said, gee, filing separately isn't in their best interest, especially with children and with a daycare because there's penalty and earned income credit. And there is a way around it. There's a workaround, isn't it? If you have outstanding student loans, or if you have bad debts or bad taxes due, there is a workaround.
Yep, it's called an injured spouse, and then for New York, it's a New York 280, which is a non-obligated spouse, and that way their debt, as long as you have wages, doesn't hinder your refund and touch your refund.
That's right. So if, let's say you had a spouse who had outstanding student loans,
Right.
and you know they're going to seize the refund, right?
Yep.
If you file as an injured spouse or non-obligated spouse, they can only take the part of the refund that goes to that innocent spouse, right?
So if the one spouse isn't working and the spouse that isn't working has the debt, you should get the majority of the refund.
So don't just file separately. There is a workaround.
I think Frank is saying go to one.
Okay, we got Ann. Hey, Ann, this is Esther Gilius. How can we help you?
Could you tell me, a couple that has 3 children, what is the minimum that they have to earn in order to get the earned income credit?
They need earned income.
Yes.
How much earned income do they have?
Very low.
How much?
4,000.
They get a big earned income credit, like $1,500.
Say that again?
They'll get about a $1,500 earned income credit.
Okay. What is the maximum earned income credit they can get?
The maximum they can get is wages up to like $52,000 if they have more than 2 children.
Okay. They have 3.
Okay, so they get an earned income credit. They're going to get a nice big earned income credit.
Right.
Well, here I got it right
And then
here.
they're going to get one
All
in
right,
the
so you
state,
said how
too.
much? 4,000?
Yes.
All right, for 3 children, they're going to get $1,811.
Okay.
And on the federal and on the state, another 20%. So they're going to get well over $2,000.
Okay. Thank you very much.
You're welcome.
Anytime.
That's what people don't know, is that we actually have a welfare system in our tax code, and they give you money if you have children at home. Kids are worth a fortune. Anyway, I'm Esther Golias, the tax lady from EG Tax. Give us a call if you need us during the week. Our website is egtax.com. I hope you'll use us. We love you. Have a great week. Bye-bye.